Heya Cryptozens. Tonight's show. Senator Warren fighting to keep Wall Street and crypto apart. Coinbase Soars on BlackRock deal, and Coinbase former employee pleads not guilty. It's 10 p.m. Pacific time. The date is August 4th, 2022. Welcome back to the Crypto Overnighter. My name is Nikodemus, and I'll be your host. The cover model, mascot, and co-host for this podcast is Tex, and together we take a nightly look at the crypto, NFT, and metaverse space and the industry that surrounds it. And keep in mind, nothing in this show should ever be considered financial advice. U.S. Senator Elizabeth Warren is no friend to crypto. In fact, some have suggested that she might be downright anti-crypto. Well, it looks like she's on track to reinforce those notions, because she sent a letter that, if enacted, would pretty much kill bank-provided crypto services, at least according to a Bloomberg report on Thursday. Senator Warren is a member of the Senate Banking Committee, which, if you listen to this show on a regular basis, you know that the Senate Banking Committee is a hotbed of crypto-related activities. Now, usually, it's centered around new or impending legislation, but not always. Sometimes it's just a way for a senator to throw their weight around and try to manipulate the players of the system. Well, it would appear that's what she's doing here. She wants to keep crypto out of Wall Street. So to that end, she's seeking to put pressure on the Office of the Comptroller of the Currency, or the OCC. Now, that's who they are. As far as what they do, the blurb on OCC's website says, quote, "The OCC charters, regulates, and supervises all national banks and federal savings associations, as well as the federal branches and agencies of foreign banks. The OCC is an independent bureau of the U.S. Department of the Treasury." So Senator Warren is going around trying to get committee members and senators to sign on to this letter to the OCC. In that letter, they're urging banks to stop providing crypto services such as crypto custody. Now, why would they do this? Well, because they feel that if they start issuing guidelines on crypto, you legitimize it. If you legitimize it, then the banks are going to get into crypto. They feel like that puts the banking system at risk. Now, frankly, I think crypto is going to be the only thing that could possibly save the banking system, at least in the short term, but that's kind of beside the point. And it's actually kind of a scolding, scathing letter. I mean, sure, parts of it are okay. They want the OCC to work with the Federal Reserve and the Federal Deposit Insurance Corporation, the FDIC, to develop an alternative approach to dealing with crypto, one that protects customers and promotes, quote, safety and soundness of the banking system. But then the tone changes a little. The letter said, quote, "We are concerned that the OCC has failed to properly address the shortcomings of the preceding interpretive letters and the risks associated with crypto-related banking activities, which have grown more severe in recent months." According to this letter, the OCC's rules and instructions weren't enough. They aren't enough to protect the financial system from crypto volatility. And this is not speculation about their intent. The letter specifically calls for modifying the rules and removing crypto banking guidelines to keep banks from getting involved in crypto. And in kind of a chilling move, they're also asking for the current total of regulated banks that offer crypto services, as well as the total dollar value of those services. Now, at present, we don't know who has signed on to this letter. It will be interesting to compare and contrast the names of this letter with the names of those who are supporting pro-crypto regulations. After all, midterm elections are right around the corner, less than 100 days away. Remembering who is pro-crypto and who is anti-crypto might be a good thing to do before you fill out that ballot. At the time of writing, the global crypto market cap is $1.06 trillion. It's down 0.76% in 24. The top 5 cryptos by market cap are Bitcoin down 1.58%, Ethereum down 1.83%, Tether, USDC, and Binance Coin up 2.51%. So Coinbase put up a new blog post today, Thursday the 4th. And this one post launched their stock like 18% on the news. And that's because Coinbase is partnering with BlackRock. So BlackRock is the world's largest financial asset manager. Currently, that firm holds $8 trillion in assets under management. Now, BlackRock has this management platform called Aladdin. And this announcement means that BlackRock and Coinbase are partnering up to provide BlackRock's Aladdin platform users. They get direct crypto access. That's right. If you are a user of Aladdin and you sign up for Coinbase Prime, you're in. You get crypto trading, custody, prime brokerage, and reporting. Aladdin is an acronym. It stands for Asset, Liability, Debt, Derivative, Investment Network. Now, if you're not familiar, Coinbase Prime is a new offering. It started up in September of last year. It's their institutional wing. It, as a platform, offers trading, custody, prime financing, staking, and more on over 300 digital assets. They're built to service things like hedge funds and asset allocators, corporate treasuries, and of course, financial institutions. Now, Coinbase tweeted the announcement to their 5.2 million followers. They said, quote, "We are proud to announce a partnership with BlackRock. BlackRock's Aladdin clients will now have direct access to crypto markets through Coinbase Prime." And from BlackRock's side of the fence, their global head of strategic ecosystem partnerships is Joseph Chalom. Now, he is quoted as saying, "This connectivity with Aladdin will allow clients to manage their Bitcoin exposures directly in their existing portfolio management and trading workflows for a whole portfolio view of risk across asset classes." Now, what does that mean? This is pretty much just for institutional investors, or the obscenely rich, I guess. It means institutional investors have access to Coinbase Prime directly through a user interface. They'll be able to use that to buy crypto-related products like exchange-traded funds, custodial services, and brokerage services. Coinbase Prime is custodied by Coinbase Custody Trust Company, and they are regulated by the New York Department of Financial Services, which is relevant because this is the first good news I have heard for Coinbase in a while. They've been in regulatory trouble lately. The Securities Exchange Commission is gunning for them over that deal with the Wahi brothers. 9 coins offered by Coinbase that the SEC has decided utterly without warning. These are securities. AMP is one of those. Now, I'll be talking about Mr. Wahi in a bit, but that's not it. They've been having other problems. Cathie Wood reportedly dumped a whole bunch of their stock at the all-time low, by the way, so she clearly thought it was going to get even worse. They've had massive layoffs. They've had to rescind job offers. They sunk a ton of money in the NFT marketplace, and that went nowhere. So it is nice to see something good for Coinbase here, which is, of course, why their stock is up. Shares closed Wednesday at $80.81. They opened at $106 this morning. They got a high of $115 before trickling on down to $88.90, which was the close. That's a nice little 10% bump for the day. It's also interesting because I think some people got screwed because their stock also jumped 20% on Wednesday. So this is possibly a short squeeze. So the bears, they might have gotten hosed on that one. The global NFT market cap is up 0.3%. Sales volume is down 4.87% in 24 hours. According to CoinMarketCap, the top 5 NFT collections by sales volume are CryptoPunks, followed by Bored Apes, Mutant Apes, CloneX, and Otherdeed. Now keep in mind, some of these collections have very volatile prices, so do your own research. According to Reuters, Ishan Wahi went to court on Wednesday. The former Coinbase product manager was accused of being involved in insider trading by U.S. authorities. Mr. Wahi has pleaded not guilty to the 2 charges of wire fraud. This was in response to wire fraud charges based on his participation in an alleged insider trading scheme. And so it came to pass that the U.S. Department of Justice charged the former employee, as well as his brother, Nikhil Wahi, and their buddy, Samir Ramani. All of them were charged with allegations of insider trading. From the DOJ's side of things, they're saying that Ishan Wahi used his position at Coinbase to get the inside scoop. See, he'd find out what coins Coinbase was going to list, and then he'd give his brother and Ramani that information. Wahi's brother and Ramani would then buy a bunch of that coin. Once Coinbase listed that coin, then they dump that coin and make off with the profits. They're alleging the suspects did this on 14 separate listing announcements, 25 different tokens covered over the course of those 14 listings. Now, off of that, Nikhil Wahi and Ramani pocketed around $1.5 million. Well, that money isn't doing either of the Wahi brothers any good. If they were wise guys, you could say they got pinched in Seattle. And you'd also say their money is still on the lam. Because while the Wahi brothers were picked up, their buddy Samir has been in the wind since July of last year. And these are substantial charges. They come with like 20 years penalty on conviction. I don't know about you. I am not willing to risk my job, my reputation, and 20 years of my personal freedom for $500,000. The risk manager in me just says that that's a losing proposition. Now, there are a couple of points of interest on this case. One, it's probably the first case of insider trading involving cryptocurrency. And two, as if that weren't enough, the SEC got involved. They decided to run their own parallel investigation into the happenings, and while the U.S. Department of Justice didn't charge the hapless trio with securities fraud, that's exactly what the SEC is going. They're saying that 9 of the 25 cryptocurrencies involved are securities, which is interesting because there's been no trial, no hearing, no law or writ that I've ever heard of indicates that these coins are securities. But the SEC is charging them, saying that those coins are securities, which is kind of a kick in the teeth for Coinbase if you think about it. You see, Coinbase called the feds. They found out something was going on. They did their own investigation. And then they were working with the Justice Department. They were doing the right thing. And now the SEC is going after them too. For their part, Chief Legal Officer had this to say after the charges were filed. Quote, "Instead of crafting tailored rules in an inclusive and transparent way, the SEC is relying on these types of one-off enforcement actions to try to bring all digital assets into its jurisdiction, even those assets that are not securities." Also chiming in was Carolyn Pham, commissioner at the Commodity Futures Trading Commission. She called the SEC case a, quote, "striking example of regulation by enforcement." So there's a lot going on with this case. It's going to be interesting to watch. And we're going to call it there for tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. You stay safe out there, but watch out for yourselves, but watch out for each other too. We'll see you tomorrow night.